I'm Linda Eedes, and welcome to today's webinar, the theme of which is Global Themes Shaping the 2020s. Now, it's hard to believe that the 2020s are almost halfway through, and that it's been 5 years actually since the COVID pandemic. And it's been marked by huge swings for investors as well. During this time, several key themes have emerged, and today we're going to be discussing 6 of those key themes, and most importantly, chatting about how we think those themes will unfold in the second half of this decade. So, unfortunately, Dave Foord was unable to join us today. He's got a bout of flu, so he has no voice. But with me to do that, I do have 2 of my esteemed colleagues, Nick Balkin, Chief Investment Officer of Foord South Africa, and Rashaad Tayob, who is our macro strategist. And both Nick and Rashaad manage both multi-asset portfolios, and Rashaad manages some of our fixed income portfolios as well. So the first theme that we're going to be discussing is the path of interest rates, particularly in the US, which obviously sets the price for many assets around the world. So let's discuss how US rates have unfolded, and in particular the normalization that we've seen over the last 5 years, or particularly since 2022. Now, Rashaad, we saw that interest rates remained close to zero for the better part of a decade following the financial crisis. And of course, the US started to hike rates very aggressively in 2022, and we saw one of the sharpest rate cycles in US history, in fact. And we did see a few rate cuts towards the end of last year, but certainly a lot less than what the market was pricing in at the start of 2024. So let's discuss where rates are headed from here. Nick, we've heard the theme higher for longer. Yeah. Do you think that will remain the case, or could we see rates going back to these ultra-low levels at some point in the future, especially with Trump back in charge?
Yeah, I think people fixate too much on what's the rate going to be? Is it 4.5%? Is it going to be 5%? You know, I think there's too much fixation on the absolute return or the absolute number. I think for us, it's more around the real rate that's way more important. So the real rate right now is around 2.5%. And I think when you think about that and just try and unpick what that means. So 4.5% interest rates right now in the US and 2.5% real, that means around about 2% inflation implied in the US. What I think will happen is that you'll see that 2.5% real come down. Most people think it will just be purely by a decline in interest rates because that's how people naturally think it will come down. But what I think is that 2.5% will come down, probably 1% by interest rates, which will take it to 1.5%. And then you'll have a kind of rise in expectation of where inflation will be. So that 2% inflation implied, I think, will trend more towards 3%. So that gives you a real rate of only around 0.5%. That is a big change in the way the real rate might trend over time. But I think from an interest rate perspective, that probably only leads to around a 1% cut. In that world, when you think about that interest rate, I think you also got to think what happens in the long bond, because usually what happens when interest rates go down, the long bond, which is the 10-year bond, say the interest rate goes from 4.5% to 3% or 3.5%, should I say. The long bond at 4.5%, everyone thinks will come down commensurately. The problem is it's actually flat, the curve right now. So I think term premium generally is that the longer you go out on a curve, the longer or the higher the rate. So I think we'll probably see a trajectory of the interest rates going from 4.5% to 3.5%, but the 10-year bond actually staying around the 4.5% mark, interestingly enough, which is probably contrary to what a lot of people expect of the whole curve shifting down at once.
Let's take a step back, Rashaad. I mean, one of the things
if I can just add to that, I mean, I think our view is that it's going to be higher for longer. We've seen a period of ultra-low interest rates for at least a decade where real rates were zero, negative for periods of time. In fact, in the UK and Germany, real rates got to -2 to 3%. Now imagine locking in a real loss of capital of 2% per annum for 10 years. It's absolutely crazy. So I do think it's going to be difficult for rates to get that low again for 2 reasons. Firstly, if you look at the bond sell-off we had, the rise in rates, people lost a lot of money in this bout of inflation, in this yield increases. I don't think they're going to be buying nominal bonds at negative rates again, like they did, prior to the financial crisis. It's crazy that we had trillions of negative yielding debt outstanding. And then secondly, I think when you look at this globalized world that we live in, where money can flow offshore, you've got instant communication, you've got new financial systems like crypto developing, you've got a stock market which is already expensive. It's going to be very hard for central banks to run that financial repression model, the mild version that they ran in the 2010s, or the extreme version that they ran in the 1950s, where they ran severely negative real rates for a long time. I think money will flow out of the system, and therefore it's not that central banks don't believe in running ultra low rates. It's more like maybe they can't necessarily do it in the modern world.
Okay, fair enough. I think one of the things that has been very surprising for equity investors is that despite the fact that we saw the US Fed hike rates by 5% from the starting point in 2022, US equity markets have continued to power ahead. And of course, the US economy itself has actually been fairly robust. Why is that the case, Rashaad? Why haven't those, hiked interest rates, especially since it was so sharp and so aggressive, why hasn't that fed through to the real economy in the US? Let's start with that, and then we can talk about the markets next.
Yeah, you mentioned it was a very aggressive rate hiking cycle. So you went from 0 to 5.5% in just over 12 months. Now, for an economy which had been built for the last 15 years on almost zero rates, you would have expected that to have a very significant impact. And in fact, a lot of commentators and analysts like myself thought that. I mean, even the yield curve was highly inverted. And if you look at history over the last 17 years, there's only been one false positive where a heavily inverted yield curve didn't even lead to a recession. So now this time it's a second false positive. So now we have two. And I think the reason for that are twofold. Firstly, we had a massive amount of government spending. So when you're talking about higher rates, generally that leads to a pullback in deficits. But this time, the US government, for example, continued to power ahead with 6% plus deficits. And with government spending being a massive part of the economy, it's very difficult to see a recession when there's that amount of spending, $2 trillion last year being pushed into that economy. And then secondly, I think what a lot of us learned were the lags, especially in the US market, are particularly long. The US consumer takes out long-term mortgages. He's able to lock in below 3% for 30 years. So that rise in interest rates, even though mortgage rates went up to 7 or 8%, that only affected the person who was taking out a new mortgage. The person who had locked in low rates, it didn't affect the amount they could spend. And in fact, corporates were quite astute in terms of using that ultra-low environment to term out their debt, such that when interest rates started to go up, the net interest cost for corporates actually went down because they were earning more on their cash outstanding, and their rates didn't. The cost of funding didn't necessarily go up. However, debt matures. People have to move, so they get new mortgages. There's new consumers. Corporates have to raise new money. So that eventually feeds into the economy, and you are starting to see the impact with maybe a bit more lag than many of us expected.
So and also, sorry to interrupt, but I think that also means that, as I was saying, like if there's an interest rate cut, immediately people think that's going to be a huge stimulation to the US economy. It is kind of, but actually the interest rates they're paying on their biggest asset, which ends up being a mortgage, is quite fixed. So they're going to actually end up not getting any of the benefits of the interest rate cuts. Yes, their credit card will, and yes, their auto, but largely the biggest component won't really benefit them at all. So everyone thinks that there's a cutting cycle and you need to get ahead of it, and immediately it's going to stimulate the US economy. It's actually not going to be the case this time around.
It's been a very strange cycle, I think, because of this government spending, the locked-in rates. I think Nick sent a chart out this week to the team where he showed the divergence between new house prices and existing house prices. And usually they move in lockstep because, you're all part of the same housing market, but you're finding that because people have to take out new mortgages at much higher rates, they can't afford new house prices, and maybe they're in more outlying areas, and those prices are now coming down. But in areas where they can't necessarily build, in the big urban areas, prices are still going up. So you're getting a very different cycle that's played out relative to history.
So what I'm hearing is that there are some reasons why rates will remain higher than the market was initially expecting, and that will continue to be the case. That they could cut rates if we start to see weakness in the US economy. Yeah. But let's talk about what the impact would be on markets, Nick, because I think often people think, well, they're cutting rates, that's going to obviously continue to boost the US equity market and keep it where it is, or even soldier on from here.
Yeah, it's like I said just a few moments ago. I think this whole thing that it's a standard economic practice. Interest rates get cut by equities. I don't think it's that way this time around. In fact, what I think has actually been the hardest thing for countries and companies outside the US is this high interest rate in the US has meant that no American really cares about sending their money outside of the US, which means strong dollar, which means high risk-free rate for a lot of the emerging markets. So actually, a cutting cycle, even a mild cutting cycle, will probably be less beneficial for the US companies and US as a whole, but way more beneficial for countries and companies outside the US. As things normalize, the pressure releases on their risk-free rate, their currencies probably do a slightly better against the US dollar. So I actually think, weirdly enough, that's why I guess around the time when it was a Trump-Biden who was going to win, if Biden had come in, there would have been probably a slightly weaker dollar, as people thought it would have muddled along slower, taken some pressure off the US economy and given them the ability to cut rates. So I do think that was a signal in itself that those things might not be as beneficial for the US economy as people expect.
And as you rightly pointed out, even though interest rates have been cut slightly in terms of the resetting of mortgage rates, as people go forward, they're going to still reset at quite significantly higher rates than they were historically.
So more than 50% of people that have a mortgage in the US have secured a rate for more than 10 years at under 4%. So that's a hell of a number. 50% of the people are feeling so good. And I think that's this bifurcated market in the US, and I think we might get into it. But the haves are doing really well. The have-nots, people outside the mortgage market, the people at the low end, are really struggling. So I think that's what kind of ushered a bit of a change in presidential candidate or president, should I say.
And you're seeing that pressure in areas like the UK as well, of course. So those of us who know people living in the UK know that their mortgages are resetting at much higher rates. So that's
they only secure a rate for 2 years in the UK, and that's the problem. So that mechanism that Rashaad spoke about, pretty much everywhere else in the world is, I mean, there's some outliers, but most countries in the world are floating. And me and Rashaad were talking about it the other day. The main reason is Fannie and Freddie in the US, which is a bit of a weird situation that they've got this quasi-government organization that is very likely capitalized, but actually backstops the whole mortgage market in the US.
Yeah.
So let's talk to our next theme, which is basically, you alluded to it now, Rashaad, which is this massive increase in outstanding government debt. And we've seen that in many countries around the world. We're going to talk about the US, firstly, because that is obviously such a power for the world in terms of markets and economies. But we've seen massive widening of fiscal deficits. So in the US, for instance, the deficit has more than doubled to $2.1 trillion, and that's gone to 6% of GDP. So that's doubled over the last decade from around 3%. And adjusted for unemployment, I thought this was quite important, is that this is 5 times what it was in the post-World War II recovery high. That was the last high that we saw on the record. And if you think about that kind of environment, post-war recovery, it's quite interesting that we're seeing those kind of deficits after quite strong economic times. So it follows, obviously, that that's been probably one of the big boosts to economic growth. So where does this resolve, Rashaad? Major fiscal deficits ballooning. We've seen debt levels crossing 100% of GDP in many countries. Where does this sort of all end up, and what are the implications of this?
So debt has been building up for a number of years now, and we'll use the US numbers as a reference point, but you could honestly apply that to any developed market. Take the UK, take Germany, take France. It's all they're all pretty much in the same position. But you've had a debt build up over a period of time. But what I think has changed is the social and the political conversations and psychology around the debt. So in the 1980s, you saw the US debt increase from 30 to 60% of GDP. There was a lot of nervousness around that. That's when, if you go to Times Square, there's a debt clock which ticks up the trillions of dollars that the US has amassed in debt. It was a big political issue. But at the end of the day, debt stabilized at 60% and nothing terribly bad materialized. It stayed there, and in the financial crisis, it then took another leg up from about 60 to 90%. And also, post-financial crisis, there was a lot of nervousness around, now we've built up too much debt, what's going to happen? But we had very low interest rates post-financial crisis, so it didn't really matter. And in fact, people who were quite frightened of the debt problem were, because nothing materialized, I think people got quite complacent. And then now with COVID, the massive spending you saw there, which it seems like people have gotten stuck into that habit, you saw debt in the US go from 90 to around 120% of GDP, which is an immense level for that size of economy. And it does put them in a difficult situation, and there's no real desire to deal with it. Historically, politicians used to debate issues around debt. Now they don't even feel the need to explain how they're going to pay for the latest unemployment or medical program. It's not even a topic to be discussed. And we know that the incoming President Trump is not afraid of debt either. He ramped it up in his first term, chasing growth. The problem here that we sit with now that you've got to this 120% of debt is twofold. Firstly, you don't have zero rates anymore. So now there's a real cost. Interest costs in the US in terms of the debt have gone up from a $400 billion per annum level. They now crossed $1 trillion. So you're now actually paying real money. And that $1 trillion is around 20% of the actual revenue that the US Treasury gets. So that 20% number is a number you usually associate with emerging markets who are in some sort of financial trouble. So they are in a precarious position because now there's an actual cost. And the second problem is that you could actually be in a trap. Now, there's a lot of research that was done, Reinhardt and Rogoff, which showed that in developed markets, once you get above 90% debt to GDP, and we are well past that in many economies, you are actually in a trap, because if you try and continue to spend your way out of it, you run up debt, but you keep growth going, but you run up more and more debt. If you try and implement austerity and cut spending, like they're talking about in the US, the problem is you then pull back growth, you have a slowdown or even a recession, and what happens is your revenues fall and your GDP falls, and then your debt spirals out of control as well. So you saw that scenario played out in Greece for a number of years. It was about trying to cut your way and have austerity. It never worked. The only way Greece got out of its problems is when they got long-term money at effectively 0%, and that's how they managed to survive. So I think the problem you sit with now is that people are not concerned about the debt problem, but you're now at a very serious point because you now have to pay for it.
I mean, it's not in the American culture. I mean, I watched Scott Bessent, the Treasury Secretary's confirmation hearing, and in every single question he got, there was no additional question around how you raise taxes to balance the budget. The biggest question that he got continuously was, how do we make sure that the tax cuts stay? Because the American culture is, we need to grow, and we need to make sure that we continue to grow. So, and I think Rashaad's right. I think this whole thing around DOGE and government spending, and I do think it's a hell of an important thing that's happening. But the problem is, if you're not going to attack Medicare, you're not going to attack Medicaid and Medicare and Social Security, those things are the biggest drivers of the deficit, combined with the fact that you have the 1 trillion interest, which is, you can't really, attack it per se. So the biggest part of the deficit is actually quite structural, and that's the hardest part, is how do they actually make a dent in it? I think to a point that actually they're debating now. Previously, there was this debt ceiling that every time the dollar debt got to a certain number, they said, okay, guys, we have to meet. We're going to have a crisis because we've exceeded the debt ceiling, and we have to come together and make a cut or make some sort of acknowledgement to extend the debt ceiling. The talk now is just to abolish the debt ceiling, which shows you that they know they're in that position, that there's it almost is taking one additional constraint away from one check and balance in the US. And I think that is quite instructive what's happening, because they know that the debt is heading upwards no matter what.
And at the end of the day, once you reach this level of debt, you either have to grow your way out of it. And I think that's going to be, it's potentially the plan. I mean, Scott Bessent talks about his 3-3-3 plan by getting the deficit down, getting oil up by 3 million barrels a day. So maybe an energy boom could help you. The US has massively increased its oil and energy production over the last decade. That's definitely helped. The AI potential boom that's coming, maybe a productivity miracle, but I do think that you need something really to bail them out. Otherwise, history has shown that you have to run higher levels of inflation in order to make that debt sustainable.
Okay, so one of the things that people say when you talk about the high levels of US government debt is that so long as there's somebody who's willing to obviously lend to them, they are able to continue to have rising levels of government debt, take away the debt ceiling, doesn't matter. But we've seen recently, Nick, that many of the central banks who would have been the traditional buyers of US treasuries have actually started to switch or to increase their reserves of things such as gold. That's obviously probably part of the reason why the gold price has done so well, hit new all-time highs. Talk to us a bit about that. Do you think that there is limitless demand for US government debt?
Yeah, so there's a few points to that. I think the first point is obviously they borrow in their own currency, which is very different to, I guess, Zimbabwe or whatever, who ends up having a mismatch of what they borrow in and what they earn their income in. So I think from a US perspective, what's made them, I guess, complacent is that fact that the reserve currency, that they have the ability to borrow in their own currency. I think through time, people start realizing that because, as you say, the buyers start questioning the stability of that whole situation, the reserve currency. And I think you have seen I wouldn't say a buyer strike, sounds a bit extreme, but you have seen countries like China starting to think, maybe we don't have gold as a big percentage of our reserves. Maybe we should actually start increasing the amount of gold reserves. Why should I fund the US government when they're so antagonistic to us? So I do think there's an element of that. But so I think there's two reasons why you have people like the Chinese government not buying the US debt like they used to. All the things that Rashaad said, they worry about getting their money back in 10 years at a fair rate. And also they've seen what the US has done to Russia and other countries. So they'd much rather own something that they have the ability to hold if there's a sanction. So I do think that those things do play a role. Interestingly, Bitcoin hasn't actually it's actually banned in China. It's quite an interesting thing. So gold continues to be the one that they feel they're adding to the reserves. And I think rightly so. I think it does have more flexibility than the overall US dollar when it comes to what they can do if they get in trouble.
I think you are seeing a number of signals recently which shows that you are reaching the extent of not necessarily a buyer strike, but a little bit of a skepticism, and people are getting concerned that the US spending and debt problem is a bit out of control. When you look at history, when you're going into a rate cutting cycle, what the best trade is to basically be long bonds. And throughout the last 5 or 6 rate cutting cycles, it was a great trade because the bonds rallied into the cutting before the cutting started and then continued to rally. This time, however, we've seen 100 basis points worth of rate cuts, but we've also seen the US 10-year bond rise by 100 basis points. People have actually lost money on bonds in a cutting cycle, which is quite a rare occurrence. And it shows that supply-demand imbalance is already beginning to work against the US, despite their global reserve currency status. So I don't think it's going to be easy this time around.
The other thing around that is, and maybe you were going to say this, but I think just over 2023 and 2024, you've seen that the US government has actually even realized this themselves. And Janet Yellen, actually, there's a lot of press around it. If people are interested, they can go and Google it and just check. But effectively, what's happened is they have almost issued no long bonds in 2023 at all. They funded the whole US government with basically T-bills, which is absolutely absurd. I think it normalized a bit better in 2024, but the mix definitely has shifted upwards, which is quite a strange occurrence to see the US government, the reserve currency, the ultimate biggest and most powerful economy, having to resort to short-term funding to fund themselves in a year. So I do think those are warning signs.
The warning, I mean, you mentioned the gold, you mentioned Bitcoin's move last year, the strange reaction of US treasuries to cuts. These are all signals that there's an element of risk for the US that's being priced into US treasuries, which was never there before. And even Scott Bessent, who's the Treasury Secretary, and he has plans to, correct things. He admitted in an interview last year that gold is actually the biggest position in his portfolio, and he's the US Treasury Secretary.
Well, Donald Trump's biggest position is Bitcoins.
Yeah. Let's not get into the Melania coins and all the rest of it.
What other coins?
So let's talk a little bit about, sort of that shift away from US treasuries into gold. Does this signify sort of an increase in sort of a movement or a divide between, we're going to talk about the geopolitics a little bit later, but do you think that will continue? Is that why we continue to have a gold position in our portfolio, or is that just purely insurance against things going wrong? I think there's still some upward momentum there.
Yeah, I mean, we can I'll handle it. I mean, I think it's all the things that I said. I mean, I'm not China, but I do think those things are relevant points. I'm not looking to be embargoed by the US government, so that's not one of the reasons. But I think the risk to the US government balance sheet, the fact that it is a great way to protect yourselves, we've spoken about the amount of risks there are in the system. It is one way to have an inversely correlated asset that will do well when other things in your portfolio aren't doing well. So I think it plays many roles, one of them being diversification and just inversely behaving to the rest of your portfolio that can create a stability of the overall portfolio.
So we spoke about, the America being one of the most powerful engines in the world. We've had a big theme, US exceptionalism or American exceptionalism. And this is important because it is a theme that's really driven this narrative. The acronym TINA has popped up again. There is no alternative. Back when rates were ultra low, it was there is no alternative to equities because everything was yielding at such low levels. Now the TINA narrative is around America. There is no alternative to America. And there's several reasons for that. Obviously, we have seen stronger economic growth than everybody expected in a rising interest rate cycle for some of the reasons that you've mentioned. We've also seen, obviously, very strong stock market performance. So there's been exceptionalism in the sense that the S&P has been the place to be. And then we've seen a lot of technological innovation. And all of these three things are wrapped up in this, sort of perception that there's no other place to invest besides the US. Now, Nick, the US is unashamedly capitalistic. They've now got a pro-growth president. With that as the backdrop, why shouldn't the S&P 500 just keep powering ahead?
Yeah. To be honest, I'm a very free market person myself, so I do believe that that is the way to run an economy. I do think that it has just been an absolutely exceptional performance from the US economy. There's been 4 times in history that the US economy has done 20% per annum for 2 years in a row. This is one. Sorry. Did I say the US market? That's exactly. Thank you for correcting me. It's been 4 times in modern history that the US equity market has done 20% per annum for 2 years in a row. The problem is 3 out of 4 of those times, the subsequent 2 years are negative. And I think that's the problem, is people are so attracted to recency bias. The fact that it's done well means it's going to do well again. They forget that there is a level that it starts setting itself when the multiple of the S&P is in the mid-20s. It's a very hard benchmark to continue to grow. And they forget that it's not only a lot of what's driven the S&P is actually PE re-rating, and you can't do that every single year. So I do think that some people start building this expectation just because of the recency. And I think, like with most things, in any mania or any exciting asset, a grain of truth taken too far is actually what leads to people losing their minds. And I think it was actually well said by Howard Marks. He wrote a whole paper on it, or a recent note on it, who's a really interesting guy to follow. And I do think that this has those feelings when you sit at a coffee shop or you go to a bar and you talk to people about markets and they say, valuation's not important anymore. look at what some of these stocks have done. As soon as people disregard valuation and say it will do well because it did well before, that's always a signal of something. And one of the things at Foord that we got to do, and we got to keep asking ourselves, is what are the fundamentals? How do we buy these income streams at a fair price and allow those income streams to grow and make our investors money through time? When you're paying too high a price, unfortunately, you can get the earnings growth, you can get this phenomenal AI boom and things that are exciting, but the share prices can actually do badly. And I think that's where we find ourselves in the US share market right now.
And I think it's also fair to say that the S&P 500 is a very concentrated index right now, very
Totally.
top-heavy. I think you gave us the number of 38% now.
Yeah, I was just looking at, obviously, there's different quotes. Some people quote the Mag 7, but I think just going to the top 10 weights in the S&P are almost 38% of the S&P. So, you buy a passive index and you think, I'm diversified really nicely. Yeah. You're very concentrated in your view, and it's very American-centric and concentrated in certain bets, to be honest. And I think, people need to understand that.
I think also that, it does feel like we're reaching like peak levels of hype in terms of American exceptionalism. I know Donald Trump and Elon excel at creating hype, and it does feel like everyone presumes they're going to just win at everything. Yeah. Trump is announcing tariffs left, right, and center, and presumably no one's counting in the fact that there could be retaliation. There's also the presumption that the U.S. is got this, this lead in tech, which you can never catch up to. But I think when you look at what's happening out of China, the developments that are happening there, it might fall a bit more under the radar of Western investors, but some of the things are quite astounding. You look at what they've done in terms of electric vehicles. So they've come out of almost nowhere. They didn't go. By going straight to electric, they've negated the advantages that the Germans and the Japanese and the Americans have had of using normal combustion engines for the last 100 years. They've gone straight to electric, and the cars they're producing are actually quite phenomenal. I mean, there was a podcast recently by the CEO of GM, and he admitted that he bought a Xiaomi electric car to test, and actually that's the one he now drives every day. I mean, that's an amazing, that's a company which used to manufacture cell phones and, household gadgets. In fact, I've got their vacuum cleaner. And in the process of 2 or 3 years, they've come up with a brilliant electric vehicle. You look at infrastructure, you look at power. China has done 25 nuclear plants in the last 5 years. The US has done just 1. In the US, they're costing $15 billion a piece. China's doing them at $3 billion. So I think anyone who's traveled to China, you went on the investor trip last year, and has contrast that with traveling to the US in the last 5 or 10 years, can see on one hand the development that's happening in that country and maybe some of the degradation that's happening in the US, and it's not necessarily going to be easy to change.
Yeah, and I think you quoted that other thing, because AI is also very topical. What were we saying? We actually discussed it yesterday around what's it called?
DeepSeek.
DeepSeek, maybe just...
Yeah, so, I mean, there's a company called DeepSeek, which in the last few weeks has released an AI model. It's actually a bunch of quant traders who are running a $15 billion portfolio at one stage, a very successful quant fund, pivoted to AI, have done phenomenal development, and they've released a model which competes with the best OpenAI model, and they've done it at 90%, at only 10% of the cost, 90% cheaper. So it's that AI lead. We hear a lot about, the Microsoft's investing $80 billion, the OpenAI, Claude, but the Chinese are doing amazing things. And in fact, this week, the high-profile tech journals were reviewing this Chinese model, and they are acknowledging that it's on par with the best US models. So there's not necessarily an unassailable lead from a tech perspective that the US has.
Yes, absolutely. And I think, it's fair to say that whenever there is a story, valuations can run well ahead, even though there is, as you say, the fundamental of the company is actually quite strong. And I think one of the examples for me that's illustrative of this, which is very recent, because of course everyone talks about, examples from 10 years back, is Novo Nordisk, which of course is the company that is one of the companies producing these obesity drugs, GLP-1s. And of course, that had a very strong run. And the underlying earnings of the companies will continue to be strong. These drugs are actually, sort of making their way into the economies and widespread use. But that share price is actually down 40% from its peak, last year.
People sometimes confuse prospects of a company with share price prospects of a company.
Yeah, and it doesn't mean that the underlying company is not going to continue to do well. It just means that the market just got way ahead of how those earnings were going to unfold. So, Nick, obviously the question to ask you is, given that view, where are we invested globally, if not in the Magnificent Seven specifically, certainly to the extent that the S&P is weighted?
So as I said, I think we're biased to investments that are much more reasonably priced. I think there are some in the US, but actually there are a fair amount outside the US. So we use examples that we've spoken ad nauseum about some of Chinese stocks. I don't even want to go through those. People know that they much cheaper value, better earnings growth prospects, so there's a lot of angle around that, but I think there's more to it than that in the global portfolio. Companies like some of the oil majors that are really cheaply priced, almost 8% dividend yield even at the current oil price, are quite interesting to us. And then we've got many different interesting niche ideas. I don't really like talking stock specific, but a company like Fever Tree, which is not everyone knows it, but I mean globally it's a very, very well-renowned accompaniment to gin, if it makes a high-end tonic. It's really got good growth runway, and I think at a relatively reasonable price. So I pick one, but I probably shouldn't have. It just illustrates that there are many different idiosyncratic ideas. Another interesting one would be we actually got more invested in the people that effectively supply the shovels to the oil majors than the actual oil companies themselves. There's a company that does all the the 3D scans of the ocean that provide those scans to the oil majors, which is very reasonably priced. Another one that actually does the platforms that actually get the oil out of the ground. So I think there are many ways to skin a cat. I think that's what makes investing beautiful, is that there are many ways to make money for your investor. I think one of the key things when you do that is you need to not over-concentrate your portfolio to one view. So having some in America, we don't have zero Magnificent Seven. We've got some exposure, but we don't think that you should be having 30% of your portfolio in companies like that. They're great, but it's just irresponsible to weight your portfolio to a size like that. So there are ideas all over the world. I think the key thing for us is to be disciplined, to be driven by the value, earnings, and unlock of the total return of those companies over time, rather than just merely buying the best companies and saying, don't worry, guys, we got you protected. We own the best companies in the world.
And there's no price too high. Dangerous. Yeah. Okay, let's talk about local politics, because, of course, there have been lots of developments there, and we've seen quite a lot of a shift to the right in many economies. Obviously, we're going to speak again about the US to start, but, of course, you've seen sort of similar trends in the UK and France, more recently in Canada. So there is a lot of dissatisfaction with local politics, and I find it interesting that despite this US exceptionalism theme, that the US is doing so well, that of course voters have voted for change. So that signifies that, that isn't feeding through to sort of the average working class American. So one of the big hot potato issues, Rashaad, is immigration. It's also been one of the reasons why wage growth has probably been lower in the US, but has US exceptionalism and economic growth and immigration come at a cost for the average working class American?
So when we look at domestic politics in the developed world, it's basically...
Domestic being America, we're talking.
Well, I mean, if you take UK, Germany...
not domestic.
South Africa. So when you look at politics, internally focused politics, globally in the developed world, it's basic, the issue is immigration. There's not really other major issues out there. And I think this started quite a while ago, back in 2016, when you saw the Brexit vote, when you saw the vote for Trump. I think those were very strong signals from the population that immigration had reached levels which they felt were too high. Trump campaigned on building a wall, for example. Back then, it was one of his biggest points. Brexit was about, controlling your borders to a large extent. But if you look at what happened subsequently, in many countries, developed countries, immigration didn't necessarily stop. It actually accelerated. And I think increasingly, as people have not gotten what they voted for, they've had to push further and further right in order to signal that they want greater and greater controls on immigration. And I think they are getting that signal. You're seeing Justin Trudeau get kicked out prematurely a few weeks ago. He was one who really pushed Canadian immigration massively high in the last 2 or 3 years, and the people, I think, have just had enough. So I think that the pushback has started. It will continue. But I think that the mainstream politicians are beginning to hear it, and they realize that they cannot continue with this uncontrolled immigration, because yes, it might be positive from a total GDP perspective. You get more spending, you get more labor, but it has social costs. And it has costs for anyone who have to compete with new immigrants for jobs and for housing. They are net negatives, and I don't think that's been fully acknowledged by politicians over the last decade. So I do think I think the trend has definitely changed. And I think when you have a control on immigration, it is a bit problematic from a total economic growth perspective. You're probably going to see lower growth. You're also going to see potentially higher inflation if you're not getting lots of new labor coming into the market. I mean, 10 million people crossed the border into the US during Biden's term. That contributed massively to controlling wage growth at the lower end. It contributed to controlling inflation. You take that out, you start deporting people, you're going to have a potentially negative impact on the economy.
And then one of the numbers that we've spoken about is the fact that, sort of close to 90% of the labor force growth in the US over the last decade has actually come from immigration. And many of those are actually illegal immigrants. So people, sort of differentiate, but illegal immigrants have made their way into the system at those lower levels.
I think it's important. I think you've got to differentiate growth that comes from productivity gain, meaning AR, which means everyone is getting more prosperous, versus someone who's coming in to suppress a wage for the existing American citizen, which both effectively add GDP, but definitely productivity gain, getting smarter, for me, is a much better way of GDP growth versus this
just increasing the population.
Increasing the population, but actually net not actually benefiting the existing people.
And it's interesting now, you're seeing a pushback against immigration, not just on the low end. So historically, it's been mostly the cost of labor. People at the higher end were probably more pro-immigration because the cost of services, the waiters, the nannies, etc., it helped them get cheaper services out there. But you're seeing this recent fight over the number of H-1B visas. These are skilled immigrants coming from India, coming from China, and there's been a massive pushback from the upper classes now because they are now stealing the jobs, I would say that, in Silicon Valley. So the tech companies are preferring to pay a foreign immigrant something like $100,000, $120,000. A local tech professional is probably going to cost you double that. So you're seeing I think previously there was a lot of pushback against being anti-immigrant, a lot of negative connotations around that, but now you're seeing a broad spectrum being more mainstream, being anti-immigration.
And this is something that we're going to have to watch over the long term because, we obviously have negative demographics in many of these developed economies. So immigration is one way to solve that problem, but it comes with, as you say, a cost to social cohesion, which is obviously creating issues in the domestic politics. So let's talk to South Africa because we've also seen some changes in politics.
Domestic politics.
Yeah, so domestic politics, local politics. Of course, we saw the formation of the Government of National Unity, and that did cause the South African equity market to re-rate somewhat from very, very low levels. So a little bit of a ray of hope is sometimes enough when stocks are very cheap to give you a little bit of an uplift. That's sort of largely unlocked. Nick, the big question that everyone is asking is, after, effectively a decade of stagnation, can the GNU drive meaningful change? What are we going to be looking at to assess that? And will the South African economy grow with or without the GNU's help?
Yeah, I think many things to deal with there, and I'll try my hardest. I think, so firstly, the question is, will it sustain itself? I mean, that's one of the biggest questions. I think looking at the surveys, if you go and look at some of the surveys that have been done post-election, you've seen that all the members of the GNU have actually increased their supporter base based on the surveys. So it does look like the people that support those parties are appreciating the GNU. That's a starting point, because the one thing that would easily break up a GNU is if actually the member parties are actually losing share. It does seem to be benefiting them over the people that are outside. And I think in life, that's what happens. The people that run businesses or are in control have the power, and I think that is benefiting them. So GNU, for now, seems more stable. You hear news articles around tensions within GNU. I think they have to sound like that, because they compete at the end of the day. What I would say is that, as you said, 2024 was just really about coming back from the abyss. So the GNU holding was actually what led to the good performance last year. That didn't mean that anyone truly felt that we were on some sort of sustainable growth path. In fact, I think they were just happy that we were around to see a few more years, and I think that was a lot of the re-rating. For us, you always, we make the joke, how do you know a politician's lying? The famous thing, their mouth is moving. And I think that's, I mean, like with most jokes, there's an element of truth to it, because we always say, watch what the politicians do, not what they say. And I think at the margin, the GNU is behaving slightly better, meaning there are some effective ministers. Some things are working better. Eskom actually started to improve pre-GNU, not related to the GNU. So I do think that what we need to watch is, are they improving the education system? Are we starting to prosecute people that need to go to jail? Are we starting to invest in infrastructure that will benefit us, the country, into the future? Watch the things that they're doing rather than the things that they're saying. As of this moment, when you haven't had growth for a long time, it is quite easy to get 1% to 2% growth for a year or two as you bounce off the bottom. What we're still struggling with is, have they created the momentum? Has this GNU, because of the GNU, created some sort of momentum that it can sustain that growth for a long period of time? And we're still not 100% certain that that's the case. I think we can't just sit there and think that we do a few little things and improve ourselves. The world is moving fast. AI is moving fast. People are getting smarter. And we are a very resource-led economy, and we actually sell European cars into Europe. We mustn't forget that as Rashaad talks about the Chinese cars getting stronger, our main export is of European cars basically into Europe. And that is a risk factor that could impact the trade balance over time.
So, given all of that, where it seems that the jury's still out on the GNU, and we'll be watching that very closely, where do we invest within South African equities without having to rely on that sort of broader economic growth that might be unlocked?
Listen, we've got used to it. We haven't had growth for forever, since I was almost in the industry, not really, but like the last 10 years, there's been almost no GDP growth. So we've learned to think smarter in South Africa, and box smarter, should I say. Some of the things that we continue to, and what's always been our way, is to try and find the companies that have the ability to grow even if the growth isn't there. That could be a company that's growing its market share, that's got some sort of niche that it's going to do well in good or bad times. Could be healthcare, could be some of the food producers that are gaining market share. It just really stock-specific, ad hoc investment ideas that I think, and we're small enough and nimble enough to take control and take advantage of those ideas when they're not being seen by the bigger guys. So I think don't rely on the sustainable 2% growth structurally being there, but actually rather good companies, discrete opportunities, and you can actually have nice concentrated weights in those companies.
And if you have that economic growth, then everyone benefits.
Yeah.
Rashaad, let's talk about the South African bond situation, because you mentioned earlier that despite the Fed cutting rates by 100 basis points since last September. You know, the 10-year Treasury yield has actually gone up roughly about 100 basis points. But the interesting thing is that South African bond yields, which are obviously priced off of that curve as a starting point plus a risk premium, haven't actually moved up in lockstep. So is that warranted? And what does that imply about, you know, sort of how South African bonds are valued right now?
So we did see a good rally in South African bonds after the formation of the GNU. And I think that was right, because the risk premium, we were heading, I think, with a low growth and high debt position, we were heading towards some sort of debt crisis in the coming years. In the coming years. But the GNU, I think, gives us the opportunity to get ourselves out of it with a bit of structural reform and a bit of growth. However, if you look at the movement that we've seen in bonds, they were cheap before that. But if you look at where they've rallied to now, our view is that at current levels, they are somewhat expensive. And we do think that that gap between US risk-free rates being at and SA bonds, that gap being at historic low levels, we think it creates some risk to bonds, and therefore we'd prefer an underweight position in nominal bonds. Where we are finding a bit more value is in inflation-linked bonds, and there we're seeing real yields up close to 5%. And these are levels we haven't seen since inflation-linked bonds came into the market in the early 2000s. And if you think about it over the last decade, if you offered me a risk-free real return of 5%, I would have grabbed it with both hands. And now we're getting the opportunity to do that, given a little bit of negativity with very low inflation, negativity around negativity on inflation-linked bonds, given the low inflation and given the fact that the central bank is talking about, reducing the inflation target. So we do think that it creates an opportunity to have a good allocation to inflation-linked bonds. And I don't think we're necessarily out of the woods. I think Nick mentioned some of the risks around the GNU. We don't necessarily know how it's going to hold, or even whether it will, translate into sustainable 2% growth. I think to get out of our debt problem, we probably need close to 3% growth, because we do have a high debt and we are still running high deficits. We're running 4 to 5%, even with a little bit of accounting gimmicks where SOA bailouts are being put below the line. We got this Jafekra selling some of our reserves and we're sticking that into our revenue. So there's been a little bit of accounting tricks to get our deficit to look a bit better than expected. But I do think because of the debt we've built up since 2010, there's a lot of work that needs to be done in order to get ourselves out of the problem. And we still need a decent risk premium on SA nominal bonds.
And talk to global bonds. Are we seeing similar themes there as well?
I mean, yields are much higher than they were before. Nick mentioned that real rate in the US at being around 2%. We do like global inflation-linked bonds at that type of level. It's our preference, because if you get a moderate level of inflation of, say, 2 plus 3%, you're getting a 5% return, which is still a decent level of return. But when we talked about the debt issues earlier, there's a risk that inflation does need to run higher, and therefore you've got that asymmetric return profile and you've got protection against something bad happening when you buy a real bond. We don't think that nominal bonds are really compensating you for that type of risk, even though the yields are much higher. Optically, they look higher than where they've been over the last decade, but we don't necessarily believe they offer value. We prefer linkers.
Yeah, it's a lot less extreme when the 10 years at 4.5. To be fair, I think starting to represent some of the base case or the normality. The problem is, as Rashaad said, there's this asymmetric benefit of an inflation linker, whereas in a fixed coupon bond, you either make a lot of money if rates collapse, or you just book an okay return. So. To us, the risk reward, it might end up that, as Rashaad said, if you get a normal inflation, you get a similar return out of a linker versus a fixed coupon bond. It's just that everything about investing is understanding asymmetric risk, understanding probabilities, understanding if we're wrong, how bad can it be? If we're right, how good can it be? Trying to understand the probability of each event happening, and then acknowledging that we don't know the future. So think about the world in those sorts of probabilistic ways, which I don't think everyone thinks. Everyone thinks, what's going to happen in the next 6 months? Let me concentrate into whatever's going to happen. If it happens, I'm a winner. And if it doesn't happen, I'll get it next time, kind of thing.
So let's take a little bit of a step back. We're going to talk about geopolitics, because obviously with with Trump in charge, there's obviously a lot of talk about rising trade tensions, tariffs, and the divide between the West and the rest certainly has been something that we've seen over the last few years, over the first half of this decade. There's obviously still a Cold War against China. The hot war against with Russia-Ukraine continues. South Africa has aligned itself with BRICS in terms of a sort of government stance, but of course most of our exports go to the West, so that's quite a tricky situation that we're in. Nick, with Trump's return, do you think that trade tensions and geopolitical tensions escalate, or how do you see these sort of playing out? Is this something that's keeping you awake at night?
Yeah, I mean, listen, he is an unpredictable fellow. But to be honest, I think his targets are, as you said, on much bigger issues than South Africa. His issues are ending wars around the world, and I really think he's serious around some of it. Whether he can do it or not, let's still see. But I do think that that's one of his focuses. And obviously, China is a big focus in his world. So I do think that the way I think about Trump and South Africa is, although there might be outlier things where he targets us because of our relationship with Russia or etc., I think that's a tail risk, but I don't think it's like a base case scenario. I think we end up rather being the collateral damage. I think I'd call it neutral with downside surprise. If he were to get hard on some of the other countries like China and countries outside with a big tariff, strong dollar, weak other currencies, I think you might see just us getting hurt that way. Or we kind of become collateral damage just in a global geopolitical fight where he locks horns with some of the bigger fish. I don't think he'll, famous last words, I don't think he'll specifically target us, but I would say we're neutral with downside risk.
And what about the rest of the world? I mean, we've seen obviously movements towards tariffs against, Mexico and Canada. Europe, I see, is rallying a little bit because, there's been less talk about tariffs for Europe. Rashaad, the BRICS actually now represent quite a significant proportion of global GDP. To what extent can the rest of the world, sort of do deals amongst each other and sort of exclude the US or the US dollar, or is that just unrealistic given the global world within which we operate?
So I think it's getting increasingly realistic. If you look at where the US was, back in the 1970s and 80s, they were about 40% of the global GDP. They're now down to the 20s. The rest of the world has really come up in terms of the size of those economies. If you look at the rise of China and India, they are now quite formidable economies on their own. And when you have US policy getting increasingly aggressive from a trade perspective, I think it makes sense that they try and form a common bloc, even if though the interests of China, India, and Russia are not necessarily perfectly aligned. So I do think that trend that we've seen in the first half of the decade of increasing collaboration between the non-Western countries, I think that will continue. And I think the best way for South Africa to play it is be as neutral as possible and benefit from both sides. I think there's a lot for us to gain from exporting to China and having relationships there. China is very keen to invest all over the world to increase their influence, while making sure that our Western export markets still remain open. I don't think we need to get involved in fights which are very far away and honestly don't really concern us.
I think that's something we spoke about also, and I forgot to mention it, just the fact that Trump is he's not a peacenik per se, he's just America first and not wanting to waste a lot of money fighting all these wars. So it's actually more of he's very transactional in everything that he thinks about. If a war made him money and made America stronger, he might be prepared to take it on, but he's very transactional in the way he thinks about it. I just forgot to mention, I think that is important to highlight, just the mindset behind Trump, very transactional in how he thinks. And you made mention around tariffs on Mexico and Canada, and we were talking earlier just actually with Dave around the art of a deal that Donald Trump wrote, and his whole thing is rather go really crazy with an aggressive proposition, and then you got a negotiating. You can negotiate down from that, and I think some of these things Is he going to place a 25% tariff on Canada? I don't think he's going to place a 25% tariff. But could he use it as a negotiating tool to get 1 or 2 concessions out of Canada? I think he can.
Yeah, I mean, just in the last couple of days, he's proposed taking 50% equity stake in TikTok. He's also proposed eliminating the federal income tax. So,
take care over Greenland.
So he kind of throws things out there. But I think that this paradigm we saw where the US is a bit more aggressive about pursuing its interest, it has put people on edge. When you talk about expropriating an asset like TikTok, that's a new paradigm. When you talk about freezing and expropriating Russian asset, that puts anyone who holds US dollars who's not perfectly aligned on watch that maybe my dollars are not secure. Maybe my investments in US companies are not secure. So I think that that this polarization is going to continue, and I think that it is a risk that the rest of the world has to take account of.
Lastly, because tariffs have been such a thing that's been dominating news flow, do you think that tariffs are good for the US economy, or what do you think the long-term implications of tariffs are? Nick, do you want to
I think there's many schools of thought. I think the way they spin it is that someone else is paying a tax to sell goods to the consumer, so they're not officially paying it. I use a context of South Africa, and where we have effectively taxes on our chicken and a whole bunch of other taxes on steel and a whole bunch of things that put up barriers to people importing goods. So my take is that initially a tariff is obviously very good for the country that initiates it because their currency appreciates, but it's actually a sign of weakness because why you need to protect that industry. I mean, surely the industry can stand on its own 2 legs, that you need a tariff to protect it. So I do think there's an important dynamic that you need to think about. But listen, I'm not one that totally writes off the US. I don't think that the BRICS, I mean, we can deviate in some things, but I don't think that this is the moment that the BRICS and outside America are strong enough to de-link from America. And I think they need each other, and I think they acknowledge that they need each other. So I don't think this is the moment that it actually de-links. But I mean, we can't agree on everything.
Then, as you point out, there's a difference between how the economy does and how the market does, given where valuations are currently pricing in a lot of that good news already, should it come through.
Yeah.
Well, unfortunately, we could talk about these things all day, and often we do spend hours talking about these things, but that's all we've got time for today. So I'll wrap up here. Thank you very much, Nick and Rashaad. I'm sorry to everyone that Dave couldn't join us, but it does prove that this is a live webinar, at least. If you've enjoyed this session, please do subscribe to our podcasts on Spotify or Apple. You'll get a lot of that content on our views and what we're thinking. And we do also have a YouTube channel, which also has a lot of videos on our views and also previous webinars as well. There will be a survey that will pop up. Please do give us your feedback. We'd love to know if this was a useful session for you, and also give us some ideas about what you'd like to hear us talk about next. So thank you again, Nick and Rashaad, for joining us, and thank you to everyone who's joined us online.